Oil just jumped, stocks just fell, and most people, if they stop there, will misunderstand the whole thing. They will say this is about one attack, one country, one news cycle, one more ugly headline out of the Middle East. That is the shallow reading. I am not interested in the shallow reading. I am interested in the thing underneath it. Because what matters here is not simply that oil went up and stocks went down. What matters is that the Federal Reserve told you this conflict had the power to force a much uglier choice on the economy before many people were ready to hear it. That is the real story, not the explosion. The trap. The trap is simple. When an economy is weakening, the central bank normally wants to stimulate cut rates. Ease conditions encourage borrowing, push money into motion, make it cheaper to finance homes, businesses, inventories, deals, and dreams. That is how you try to support growth. But when inflation is climbing, and especially when energy is the thing driving inflation higher, the central bank is pulled in the opposite direction. You raise rates, you keep policy tight, you try to protect the currency, you try to stop inflation from hardening into the expectations of households and businesses, you try to make money scarcer, not looser. Those are opposite moves. You cannot honestly do both at the same time. That is why this moment matters. Because the Federal Reserve is no longer standing in a comfortable world where the right move is obvious. It is standing in a world where every choice hurts something important. And when a central bank reaches that point, people start throwing around phrases like the Fed lost control. Now, I want to be careful with language because I do not enjoy theatrical oversimplification. The Fed has not lost control in the childish sense. Jerome Powell is not wandering through the building asking random interns what rates should be. That is not what I mean. What I mean is more dangerous. The Fed is losing the ability to cleanly choose one objective without worsening the other. And once that happens, certainty disappears. Markets hate that. Households feel that. Currencies eventually reflect that. That is why I care. Now let us start where the source material starts because it gets one very important thing, right? The meeting on the 29th of April was not normal. Reuters reported that the 29th of April 2026 Fed decision was the most divided board vote since 1992, with 3 dissents against the easing bias and 1 dissent in favor of a rate cut. That matters because it tells you the disagreement is not cosmetic. It is structural. It means the people inside the institution are no longer speaking with one calm voice about where the economy needs to go next. Faysite Fayturn 70, file 0 Fayturn 902817, search 0 Fayturn 902817, search 4 Fay. That is the first crack. Because central banks live on confidence almost as much as they live on formal authority. When the institution looks unified, markets can at least tell themselves there is a coherent framework at the center. When the institution looks fractured, markets begin to fear that policy itself is becoming reactive, and reactive policy is how you move from the Fed has tools to the Fed is trapped. That is where we are getting close. Now, why are they split? Because they are staring at 2 different fires. One fire is growth. The other fire is inflation, and the problem is that the hose for one fire sprays gasoline on the other. That is the conflict. If the economy slows, the old playbook says ease, cut, support, encourage, credit. If inflation rises, the old playbook says tighten, defend the value of the dollar. Discourage demand. Do not let price increases become a permanent habit. You cannot sincerely promise both at once. That is why I say the problem is not the attack itself. The problem is that the attack landed on an economy and a central bank that were already vulnerable to this exact kind of dilemma. Now let us talk about inflation, because if you do not understand the inflation side of this story, you will miss the whole mechanism. Oil is not just another commodity. Oil is one of the economy's main transmission belts. When oil rises, the pain does not stay inside the oil market. It spills. Gasoline rises, diesel rises, shipping rises. Airlines get squeezed, fertilizer gets more expensive. Food costs eventually feel the pressure. Industrial goods feel the pressure. Everything that has to move, be heated, be cooled, be packaged, be transported, or be manufactured starts absorbing the shock. That is why oil is so dangerous. It is not just a number on a chart. It is the price of friction inside the whole system. And once friction gets expensive enough, the consumer starts bleeding. That is where this becomes an economic story, not just a geopolitical one. The source material made this point well. If you walk into Chipotle after filling up your tank and realize the tank just took the money that used to buy the bowl, then the problem is no longer at the refinery. It is in consumption. And American growth still depends very heavily on consumption. That is the link people miss. Higher fuel costs are not merely annoying. They are attacks on discretionary life. That is why the Fed cares. Now, I want to correct and sharpen one of the inflation points, because this is where nuance matters. The source document says first quarter PCE inflation came in at 4.3%. That needs clarification. The cleaner fact is this: the first quarter 2026 core PCE price index, measured on a quarterly annualized basis, was indeed 4.3%. But the March year-over-year core PCE reading was 3.2%, and the March year-over-year headline PCE reading was 3.5%. Meanwhile, the broader first quarter PCE price index in the GDP report ran at a 4.5% annualized pace. In other words, the source was directionally right that inflation worsened sharply, but the exact measurement depends on whether you are talking quarterly annualized core, monthly year-over-year core, or headline. Faysite Fayturn 70 file 0 Fayturn 932,790 search 8 Fayturn 932,790 news 18 Fayturn 932,790 news 19 Fayturn 932,790 search 2 Fay. That distinction matters because the media loves to mash together inflation numbers and then pretend they all mean the same thing. They do not. But the big conclusion is the same. Regardless, inflation moved the wrong way fast, and it did so before the latest oil spike had even fully worked its way through everything households actually buy. That is what should worry you. Because the Fed's favorite inflation measure excludes food and energy when you talk about core PCE, and even there, the picture worsened. So when people shrug and say yes, but the Fed does not look at food and energy, they are missing the point twice. First, even the Fed's cleaner inflation measures are running too hot. Second, households do not live inside core PCE. They live inside rent, groceries, gas stations, insurance premiums, and credit card bills. That is real inflation. That is lived inflation. And if lived inflation keeps rising, then the political and economic pressure on the Fed gets much harder to manage. Now let us bring the conflict back in. The longer the conflict in the Middle East persists, the more likely it is that oil remains elevated or volatile. And if oil remains elevated or volatile, then inflation pressure does not disappear simply because Wall Street would prefer it to. That is the sequence: longer conflict, higher energy pressure, worse inflation, harder Fed choice. That is why I say the conflict matters not mainly for what it means militarily, but for what it does to the central bank's margin for error. When the Fed had more room, it could pretend to fine-tune. Now it has less room. Now even small policy mistakes matter more. That is why the division inside the Fed is so important. Because a divided central bank in a supply shock environment is not just an institutional curiosity, it is an economic vulnerability. Now let us talk about Jerome Powell and Kevin Warsh, because this is where the political uncertainty layer gets added on top of the inflation. Growth conflict. The source document said Powell was about to step down on May 15 and Kevin Warsh would take over. That broad setup is right. Reuters reported that the 29th of April likely marked Powell's final meeting as chair, that his chairmanship ends on May 15, and that Kevin Warsh is set to succeed him next month. Reuters also reported that Powell plans to remain on the board of governors for a time after stepping down as chair, which is unusual and politically meaningful, because it means continuity and institutional resistance may coexist with the new leadership rather than vanish overnight. Faysite Fayturn 70 file 0 Fayturn 9028817 search 0 Fayturn 9028817 news 36 Fayturn 9028817 news 32 Fay. That matters enormously because leadership change at the Fed is always important. Leadership change during a moment of internal division, rising inflation, higher energy costs, and obvious White House pressure is much more important. Markets do not only fear bad policy, they fear unclear policy. And what do we have now? A new chair coming in under conditions where the institution is already split. Inflation is already heating up. Energy is already unstable. And the political class is already trying to push the Fed toward easier money. That is a messy starting point. Now, Warsh himself complicates the picture even more. He is not easily reducible to one simple label. Yes, he is associated with Trump. Yes, there is pressure from the administration for easier policy. But Reuters also reported that Warsh has signaled interest in rethinking Fed communication, and that some current Fed officials are becoming more hawkish because of inflation risks tied to the Iran conflict and supply disruption. In other words, the pressure system around him is not simple. He enters a chair already surrounded by contradictory demands. Faysite Fayturn 902-817 News 32, Fayturn 902-817 News 33, Fayturn 450-958 News 46, Fayturn 450-958 News 47, Fay. That is why I do not like simplistic predictions here. People want to tell you, wash means cuts, as though the whole story is over. Maybe, maybe not. The better question is what kind of room he actually has once he sits in the chair and looks at the same inflation, oil, and political data everybody else is looking at. That is a harder question. And hard questions are exactly what markets hate. Now let us talk about the economy underneath all this. Because the economy is not falling apart in one clean Hollywood collapse. That is not what the data says. In the first quarter of 2026, GDP grew at a 2.0% annualized pace, according to the BIA, helped by AI-related investment, and a rebound in government spending. Consumer spending still grew, but more slowly. That is not a dead economy. It is a more fragile one than the headline growth rate makes it appear. Faysite Fayturn 932,790 search 1 Fayturn 932,790 News 19 Fayturn 902-817 News 39 Fay. That fragility matters because you can have positive GDP and still have a consumer under pressure. You can have business investment and still have households whose real incomes are not keeping up. You can have a strong stock market and still have people swiping credit cards to survive. The source material is right to emphasize the household side of this. Record credit card debt matters. Paycheck to paycheck living matters. Gas over $4.5 matters. Because once a household is already stretched, even a marginal increase in essentials has a much larger effect on behavior than economists with elegant spreadsheets like to admit. That is why this is dangerous. The economy does not need to collapse instantly for the consumer to begin changing behavior. He just needs to get squeezed enough that he stops buying the second bowl, the extra trip, the upgraded product, the little luxuries that keep the revenue machine humming, and once enough consumers do that at the same time, you feel it in earnings. That is how an oil shock becomes an equity market problem. Now I want to turn to the stock market because the source document makes a point I agree with strongly, and I want to frame it the Buffett way. The media loves telling you that falling markets mean run away and rising markets mean pile in. That is exactly backwards. If you are a real investor, a falling market does not automatically mean danger. It often means opportunity. A rising market does not automatically mean safety. It often means less favorable prices. That is one of the most important mental reversals you can ever learn. Because if you can internalize that, you stop reacting like the crowd and start thinking like an owner. The source gave several examples from 2025 and 2026 of policy shocks, war scares, tariff announcements, and market drops that later became buying opportunities. The details are messy and some of the examples are wrapped in the style of YouTube urgency, but the underlying lesson is correct. Markets overreact. People panic, then the same assets that look terrifying at lower prices look wonderful again at higher prices, and the crowd acts like the risk somehow disappeared instead of recognizing that the price changed. That is why I tell you not to worship headlines. Headlines are noise with a business model. Price is opportunity with a clock. That is different. Now, I also want to be careful here because saying market declines are buying opportunities is true in a broad, long-term sense. But dangerous if somebody hears it lazily. Not every stock is worth buying just because it fell. Bad businesses can always get cheaper. Leverage can kill companies. Cyclical booms can hide permanent weakness. That is why the source material was right to bring up research and systems. You must know what you want to own before the sale begins. That is the real discipline. Otherwise, every downturn just becomes emotional chaos. This is why I have always preferred systems to mood. The mood will betray you. The system might save you. If you are a passive investor, then the system can be simple. Always be buying every week, every 2 weeks, every month, whatever rhythm matches your life and cash flow. Money leaves the bank. It goes into broad market funds or whatever intelligent, diversified structure you chose in calm times. And when the market falls, you do not suddenly reinterpret your own system as foolish just because the screen turned red. You continue. That is what discipline looks like in practice. Not a quote on a coffee mug, an actual repeated action that feels least heroic when it is most useful. If you are more active, the principle is the same, even if the execution differs. You study sectors. You identify the businesses or themes you want to own. You understand where the money is moving over long stretches. And then when panic hits, you are not starting from zero. You are already prepared. That is why I do not really care whether somebody is passive or active as much as I care whether they are systematic or emotional, because emotional investors always end up buying someone else's comfort and selling someone else's fear. That is a terrible way to build wealth. Now, I want to talk about 2020 because the source material brought it up, and it is an important memory. In 2020, the market collapsed at a terrifying speed, then it rebounded at a historic speed. The reason the rebound was so violent was not merely that conditions improved. The Federal Reserve and the fiscal authorities flooded the system with support at an astonishing scale. That is what people forget. And that memory has trained a generation of investors to expect a central bank rescue whenever things get ugly enough. That is dangerous, because the Fed that flooded the zone in 2020 was living in a different inflation environment. The current Fed does not have the same freedom. That is exactly why the division matters. Now, if inflation is hot, oil is unstable, and the conflict persists, then the central bank cannot simply do what it did in 2020 without worsening the inflation problem it is already struggling to contain. That is why I say the Fed is trapped, not helpless. Trapped, its old easy rescue reflex now comes with a much steeper price. Markets have not fully internalized that. A lot of investors still assume that if things get ugly enough, the answer will just be lower rates, more liquidity, and other broad risk. Asset boom, maybe that eventually happens, but the cost of getting there is higher than before. The political and inflation constraints are tighter than before, and that changes behavior. That is why this environment is different. Now let me come back to the central question. Has the Fed lost control? In one sense, no. It still sets short-term rates. It still controls the balance sheet tools. It still shapes expectations. It still has enormous institutional force. But in the more important sense, it is losing clean control over the trade-offs. It can no longer stimulate freely. It can no longer fight inflation painlessly. It can no longer pretend oil shocks are side stories. It can no longer count on institutional unity. And it is heading into a leadership transition precisely when the choice set is becoming uglier. That is what people are not ready for. They are not ready for a world where the Fed is not omnipotent but cornered. That is a very different kind of central bank. Now, what should you do with this? First, get your personal balance sheet in order. That is not sexy, but it matters most. If energy stays high and inflation persists, everyday life gets more expensive. Do not pretend your budget is immune to macroeconomics. Protect your cash flow, know your essentials. Cut stupid leakage. Do not build a life that only works if gasoline, insurance, groceries, and borrowing costs all become kind again soon. That is fantasy. Second, know what you want to own. Not in a vague way specifically if markets fall, because oil rises and recession fears deepen. What exactly are you willing to buy? Broad indexes, energy select tech, gold, cash flowing businesses. What is the list? Write it down before you are emotional. That matters. Third, keep liquidity. I am not telling you to sit entirely in cash waiting for the apocalypse. I am telling you to maintain enough flexibility that when opportunities appear, you can act instead of merely comment. That is a huge difference. Fourth, stop trying to perfectly predict the next meeting, the next inflation print, or the next policy turn. That is a gambler's addiction disguised as macro sophistication. You do not need to know the exact day the turn comes. You need to be positioned to survive and act before and after it does. That is much more useful. Now, let me end where the source material ends, because this is the sentence that matters most. Most people do not hear about Fed regime changes when they happen. They hear about them when they feel them in their mortgage rate, in their car insurance, in the price of gas, in the grocery aisle, in a stock market that suddenly behaves differently than they expected. That is why I wanted to say this. Now, the real risk is not that one meeting was noisy. The real risk is that the old clean story is broken. The old clean story was this. If growth weakens, the Fed helps. If inflation rises, the Fed fights. Those were once separate problems. Now they are colliding. And when growth weakness and inflation pressure collide under geopolitical stress, the central bank moves from problem solver to crisis manager. That is the transition. And once you understand that, you stop asking whether one attack caused the market to fall. You start asking the more important question, what happens when the economy needs rescue, the currency needs defense, oil keeps pressing higher, and the people in charge can no longer pretend those goals are compatible? That is the question, and most people are not ready for the answer. That is why I say the Fed did not lose all control. It lost the luxury of easy control, and that changes everything.